Good morning, everyone. It's 10 o'clock Mountain Time. We'll go ahead and begin. Thank you for joining us. My name is Clark Taylor with Soltis Investment Advisors. I'm one of the managing partners for wealth management. Excited to have the opportunity to help us get going on our second quarter Soltis Economic and Market Outlook call. This call is being recorded for clients who are unable to participate and can be shared shortly after the call is over. We're excited to have our Chief Investment Officer from our Salt Lake City, Utah office, Bill Wallace, on to give us this economic update. Before we turn the time over to him, I just want to make mention of the Q&A button at the bottom of the webinar. We will take some questions at the end of the webinar. If you'd like to ask a question, please go ahead and click on the Q&A button and pose your question, and we'll get to that question toward the end of the presentation. With that, we're excited for Bill to come on and give us some economic update. Bill, take it away.
Thank you, Clark, and welcome everybody. As you can see from our agenda today, we're going to start off with an economic and market outlook, looking at some of the fundamentals of the economy and market as we see them right now. Then we'll be taking those fundamental ideas and talking about some investment themes that we've been working on in your portfolios. We'll have a summary, and then we'll have time for Q&A at the end. So this is our summary slide of a lot. There's a lot of data here, and I think good information. It's something that you can refer back to as you want. But just kind of going through this list to set the stage for where we are right now. Obviously, in interest rates, we continue to be at historically low levels. Those low interest rates are attractive, make equities attractive relative to fixed income. In terms of gross domestic product this year, the economy and the recovery is really strong. We are seeing growth, or expecting growth in 2021 to be in a 6 to 7% range. That's a really strong recovery. Keep in mind, say the last decade, we've probably averaged 2% GDP growth on an annual basis. So that 6 to 7% number is very strong. That number is not guaranteed. If we have, if the rollout of the vaccines, if something happens in COVID with the variants, maybe some things could take the wind out of the sails of the economy. But as of right now, we think we're going to have a very strong year economically. Corporate earnings also are returning very strong. In the depths of the COVID, when we first started the policies of closing the economy, the markets were pricing in an 80% drop in profits for 2020. Thankfully, the economy did much better. Profits only came down about 20% in 2020, and we're seeing profits that will, in 2021, that could be up as much as 25%. That again is a very robust increase, and we would be profits in 2021 should be higher than they were in 2019 before the COVID occurrence. Fed policy. The Fed continues to be very accommodative. This is positive for equity investments. We do have some question about what this could do to inflation. We'll be talking more about that as we get into the other parts of the presentation. Valuations. Clearly, the stock market is fully valued in a lot of ways. And if you look at price earnings ratio alone, it's overvalued. But we think based on the level of profits and the level of interest rates that equities still are an attractive investment in 2021. Regulation, we're still trying to figure that out, but it looks like government policy will be increasing regulation, which could slow growth over time. One of the things we wanted to point out, things have been going up pretty regularly in the markets. Geopolitical events is an area where we could see some sort of unforeseen thing happen that could disturb the markets and cause a correction. We've noted China-U.S. relations, Gulf tensions, cyber attacks. There could be a long list here, but nonetheless, that is an area where that could be something that could be hard on the markets if something were to come up. Despite low yields, we continue to feel that fixed income has a place in our portfolios to provide stability and diversification. And the last three we can kind of put together: fiscal policy, healthcare policy, and infrastructure policy, kind of all under the umbrella of fiscal policy. As you know, the government's been very aggressive with fiscal policy. It's putting a lot of money into the pockets of consumers, and that's part of the reason why GDP is going to be as strong as it is. Unfortunately, we don't think a lot of those measures are long-term positives. Healthcare policy, things are going pretty well, especially in the U.S. in terms of vaccine rollout, but there's still question about the variants and how getting a larger percentage of the population vaccinated, which could be another thing that could slow the economy if something were to reverse there in terms of positive vaccine developments. And infrastructure, we just wanted to put it on the list of things to be aware of. It's too early to tell what infrastructure might do for economic growth. We'll be monitoring it and judging. I think our viewpoint will be within the infrastructure bill. What is truly investment dollars spent on investments in infrastructure versus what are dollars that are really just being spent on current consumption? So that'll be kind of our base gauge there. So jumping into a little bit more specifics, I mentioned the price earnings ratio. This chart here just shows the price earnings ratio, and it is above normal. And that would be, you could point to that and say the markets are overvalued. And we would agree with that. If you look at it in that sense only, the equity markets are hitting all-time highs. And valuation is a bit of a concern to us, but in other respects, as you look more broadly, I mentioned corporate profits. This chart here does a great example of how strong corporate profits are. As you can see over on the right-hand side of the chart, that green bar, which reflects 2020 corporate profits. And I mentioned that they went down about 20%. You can see here that's a lot better scenario than if they were to have gone down 80%, as some thought they might. But then you can see 2021, 2022, the corporate profit outlook is positive. Another factor into valuation of the markets are interest rates. This yield curve chart shows different yield curves for different time periods. The time period we're in right now is the blue line in the middle. And you'll note, again, rates are very low at the short end of the curve. The 10-year rate is about 1.59%. That's gone up significantly. And some have asked, well, wait a minute, I thought the Fed wanted to keep rates low, and they do. But one phenomenon, Fed has greater ability to control the short end of the yield curve. Financial markets and investors tend to have a greater ability to factor, set the rate at the longer end. And essentially, bond markets are a little skittish about Fed policy and how aggressive the Fed and the government are being with monetary and fiscal policy. And that's really what's been pushing up 10-year rate. So the yield curve is steepened here. But nonetheless, with short rates very low, that makes every dollar of profits that companies put out even more attractive. And so that combination of good corporate profits and low interest rates make us feel like the equity market is a reasonable place to be invested at this stage. And of course, we're long-term investors, so we're always going to be invested in equities. Here's a chart that just shows Fed policy. Again, their short-term policy is for near zero interest rates. And some time before, it could be 2023 before they start to raise rates, unless inflation starts to get hit to their benchmarks, or if the economy keeps growing. They seem to be pretty determined to keep rates low. So, what are these low rates? What have we been doing with portfolios to deal with these low rates? I mean, essentially, we're saying low rates plus good earnings makes equities attractive relative to fixed income. So we actually have an overweight in our allocations to equity and an underweight to fixed income. But we've also tried to be more thoughtful about our fixed income portfolios. A couple of things that we've done. We took an explicit position in high yield fixed income, more otherwise known as junk bond. It's just lower credit quality. Typically, we have not taken an explicit position. We've left that to our bond managers to determine, when and if they want to own high yield. But we felt like there was an opportunity with a strengthening economy and with good spreads to add to high yield. And we've done that, and that's proven to be a good tactical strategy for us. Another thing we did, which was unusual, as you may remember, we rebalanced portfolios right in the jaws or teeth of the worst part of the drawdown back in April of 2020. And so we were buying equities at a very opportune time. Well, equities recovered so well, so quickly, that at one point our portfolios were about 11% overweight our target weights. And we were comfortable with an overweight in equity, but not that big of an overweight. So we were going to rebalance, and we just didn't really feel good about buying fixed income. So we put our core portfolios into a buffered structured note, which we thought had characteristics that were kind of in between equity and fixed income in terms of its risk level. And we're pleased to note that once that was all done, that strategy added 8.44% above what would have happened if we'd gone into fixed income. Of course, we always have an allocation to real estate investment trusts or REITs. And we've also put money with fund managers that are investing more in mortgage-backed securities, which are two places where you can still find yield above kind of the norm. Okay, now shifting gears, this is a kind of a big hot button area, inflation. The market's kind of pricing in higher inflation. That's why the yield curve's gone up. There's a lot of economists that argue that inflation, and this is the Fed's base case, is inflation will probably pop for a little while, but that it's not going to get out of control or get maybe higher than into the 2+% range. But the market's kind of worried about inflation. So this chart just basically gives some arguments. What's pushing inflation lower? What's pushing inflation higher? We have a high savings rate. That means money's staying in the bank and in people's accounts rather than being spent. We still have a higher than normal unemployment rate. The velocity of money, how much money circulates through the system, how quickly, is low. Technology and globalization, those are factors. Technology can increase productivity, which can hold down inflation. On the other side, at the bottom, we actually obviously have supply disruptions from the pandemic. They're supplying it, so supply is a problem. We potentially will have pent-up demand. A lot of us have been holding back on spending, and as things get more back to normal, there could be a lot of money that people want to spend, which could push prices higher. The China's recovery, they've had a very strong recovery. They tend to have very significant demand for commodities, so we see commodity prices going up. And until recently, the US dollar was going down in value, which is inflationary to US consumers. It has popped up a little bit, but overall, we think that's probably more, the dollar probably does continue to have more downward pressure given the large increase in money supply. So there's these two competing interests, and we're trying to figure out how to best manage that. One of the things that this chart doesn't do, it doesn't really talk about the potential for inflation coming from monetary policy. You can see here, this is the monetary base. This is basically the amount of money that's floating around in the system or could be used. As you can see, the monetary base has grown substantially. Even in the past year, some measures of money supply are up 25%. There's some economic thinkers who argue that inflation is primarily the result of excess money supply. I would say right now, most don't really subscribe to that theory, but that's one of the things that's got the bond market a little bit on edge, is this large money supply growth. As you go to the next slide, and this is, I mentioned earlier, this is bank reserves. So bank reserves have gone up at the same time as the money supply has gone up. This is an important question in my mind, is, what are the banks going to do with those reserves? Are they going to be comfortable sitting in their Fed bank account, earning some interest and not having to pay, not having to factor that into their capital needs? Or are they going to be more aggressive in lending? I think that's one of the key questions about, will this monetary policy lead to inflation? So with that outlook, we have been worried about interest rates potentially rising, especially 6-8 months ago when we were very low across the entire yield curve spectrum. Several things we've done to protect our fixed income portfolios. One is we have a direct allocation to Treasury inflation protected securities. These are US government bonds, so they have very high credit quality, but they will be adjusted in value in terms of what happens to the consumer price index. So basically these bonds are protected against increasing inflation. And that again is an allocation in our fixed income portfolios. We've been running an average maturity in our fixed income portfolios, which is less than our benchmark. And what that means is as interest rates rise, our portfolios would do better than the benchmark. That's another one of the steps we're taking to control against the potential for higher rates that would result from higher inflation. Again, I mentioned this earlier, we're over equities versus fixed income. That's one of the stances we're taking. And lastly, we also have an allocation to REITs, and REITs tend to perform better. They're tied to real estate. Real estate's a hard asset. Hard assets tend to fare better in an inflationary environment. So those are the steps we've been taking to in fixed income portfolios on this inflation issue and interest rate issue as well. The next slide, we've talked about this before and it's just gotten better. We are overweight small caps and mid caps in our tactical allocation. This chart here on the left, that graph, anytime the blue line is above zero, essentially what that's saying is small caps and mid cap stocks are doing better than large cap stocks. And we made the decision to overweight small caps and mid caps relative to large caps when, in 2020, maybe even in late 2019 for small caps. And bottom line is it's working well. And you'll notice another thing we want to point out is again, as long as that line's above zero, that means that small caps and mid caps are doing better than treasuries. So even when you see those periods where the line's coming down, they're still doing, until it gets below that black line, you're better off there. So the point to make is we feel like the mid caps and small caps still have an opportunity to outperform large caps for the foreseeable future. So we maintain those overweights. One of the things you may have heard, growth stocks have been the darlings for essentially almost a decade. And this chart just shows on the left, when you're down below that line, it means that growth is expensive and value stocks are cheap. That's where we are today. We've started to see value outperform growth. We did take a tactical move, a modest tactical move in our core portfolios in our last investment committee meeting, where we took a little bit off of the growth side of the equation from a growth manager and put that with a value manager to make a more explicit position in value, because we think that could lead to a good opportunity. Over on the right-hand side of this chart, it just shows you what kind of industries are the main beneficiaries of a growing GDP. You'll notice industrials, financials, consumer services. These are industries that have struggled, compared to growth companies like technology and so forth. It'll be interesting to see. We've already started to see this occur, and we think it probably has legs to continue as we continue on with this year. So with that, I've kind of ran through things pretty quickly. I want to make sure we have time for questions. But here's our key takeaways. Again, equities are still attractive on a relative basis to fixed income. We recognize that valuations are a little bit questionable, but nonetheless, again, based on profits and interest rates, we think equities are attractive relative to fixed income. We've taken steps to protect your portfolio from rising inflation or the potential rise in inflation. I was telling the guys here at our office years ago, earlier on in my career, we used to say that the Fed's role was when the party gets going, the Fed needs to come in and take the punch bowl away. In other words, as the economy gets going, the Fed needs to start, making sure that things don't get out of control. Right now, to use that analogy, not only is the Fed not taking the punch bowl away, the Fed is staying at the party and the Fed is spiking the punch bowl. So we'll see how it all unfolds in the next year or so, maybe next year to 2 years. Small cap and mid cap equities, again, we think they look attractive and have overweights there. We're trying to be thoughtful about our fixed income investments. We recognize that it can be frustrating to have a fixed income investment that doesn't have as high as yield as they typically have had, but we emphasize the importance of the risk reducing aspects that we have. But when we say we're being thoughtful, we're thinking outside of the box and trying to see areas where we can get increased yield with taking acceptable amounts of risk. We did that with the high yield. As many of you probably know, we also are using alternative investments to get even better yields. Again, we want to make sure that we expect that there'll be a correction. Who knows when it will be. We don't foresee a major difficulty in the markets, but we do expect a correction. We think the market's due for one. Perhaps it comes with some sort of negative news geopolitically. Another area that we're watching is what we're referring to as investor psychology and behavior. We didn't really mention this in the body of our presentation, but we've noted that margin levels are at very high levels. So if investors get skittish for whatever reason, and this kind of euphoria really focus on the upside rather than the potential risks, that could be something that could push us into a corrective phase. But with that, I will stop there, Clark, and be happy to take questions if there are any.
Thanks, Bill. Appreciate that. Earlier on the call, I failed to recognize that we have Ammon Christensen, one of our investment analysts on the panel with us, as well as Sean Woods, our Director of Investment Research. So appreciate their help in getting these calls put together. We've got a couple of questions coming in, but maybe Bill, while they're coming in, can you make a comment or two on the international equity markets? And we know that Soltis has had a pretty significant weighting in international equity over the last few years. Any comments that you'd like to make or can make about international?
Yeah, we believe in investing internationally, number one, for diversification reasons. The U.S. economy and markets do make about half of the equity markets in the world. So we feel like, if you stay totally focused on U.S., you're ignoring half of the opportunity set. More immediately, we like emerging markets at this stage of the economic cycle. We have a modest overweight to emerging markets. Unfortunately, I don't have the slide with us, but expectations are that emerging market profits will be up 40% this year. That's one of the reasons we're attracted to those. We also wonder if there's a potential decreasing value of the dollar given monetary policy, and emerging markets tend to do particularly well in when the dollar is going down. And one last thing, I mean, we're less excited about the developed markets, but nonetheless, we do think there's opportunity there. So we do have an allocation to developed. But importantly, as investors, another one of the main reasons we like to invest internationally is to diversify away from the US dollar. When you're in, we don't hedge our foreign investments. So if the dollar goes down, our foreign investments benefit. So as you think about these foreign investments, think about it's a way that you're diversifying away from the US dollar.
Thanks, Bill. I guess while we're there, a question, what are the thoughts about China's desire to make their own currency the global currency in place of the dollar?
Yeah, that's definitely something that they aspire to. Some of the most recent research I've done suggests that we're a ways away from that actually happening, or could it happen for China become the reserve currency? But I do think that it's something that is worth consideration as policymakers do make fiscal policy decisions and monetary policy decisions. I think they need to factor that into their thinking. Changing from one reserve currency to another does not happen very often, and I think the likelihood of that happening anytime soon are low. But further down the road, who knows? It will depend.
Thank you, Bill. Next question. What is our view of cryptocurrencies? Is there a place for them in the portfolios or in the coming years, now or in the coming years?
Good question. We have really done a lot of work in this space. Our original work came in, I guess what would it be, maybe in 2017 when Bitcoin was doing really well. At that time, it was hitting all-time highs, and we advised against investing in cryptocurrencies. And fortunately, that decision was right, because there ended up being a huge drawdown in the value of Bitcoin. But we didn't give up on our research there. We've done a lot of work in the space. We have not directly recommended to clients to invest in cryptocurrency. However, we have developed and vetted several different options for clients to invest in cryptocurrency. So our advisors are well informed and know how to get positions if that is an area that you want to invest. I would suggest that we've actually even put it in our policies. We would suggest no more than 10% in cryptocurrencies. And I think if we were if someone was to take a position today, I think we would think something in the neighborhood of 1% to 2% of your total investments would be probably the way to go. But again, we have not made the decision as a firm to recommend that. However, I would say that in our growth equity portfolio, there is some cryptocurrency assets in that. So we think crypto more and more. We think there's meat to this. It's more than just a passing fad. So hopefully that answers the question.
I would just echo what you said, Bill, that we have advisors that are pretty well versed and know how to help directly implement that as needed. Maybe last question that has come in, how does technology play into inflation protection and global diversification?
Well, the thing that technology can do is make us all more productive. And that the way it plays into that inflation thing is if we're getting, you think about all of the things that we can do today just on our smartphones, which I think overall tends to make us more productive. So when you say, what does technology do with inflation? That would be its main role, is that if it can increase the productivity of all of us and in general, the productivity of the economy, that can help keep inflation in check. That's in our minds, I think that's the main thing that the way technology plays and influences the inflation scenario.
Thank you. I think we're 30 minutes through. We appreciate everyone's interest and the time. Again, this presentation is recorded and happy to share that with clients. Appreciate Bill and the time he's taken as our Chief Investment Officer to talk about the markets. And we wish everybody a great second quarter, and we'll look forward to this call happening again in July. Have a great day, everybody.